Welcome back, everyone. This week we're going to be discussing the Deepwater Horizon fiasco of 2010, as well as the nuclear meltdown of Fukushima in 2011, to illustrate and better understand such expressions as if you're going to panic, be the first to panic, and also to understand why one should position size accordingly in the commodity sector due to one-off events that can really radically and rapidly change the risk-return profile of your investment. So BP, Deepwater Horizon oil spill, April 20th of 2010. Maybe they were celebrating the cannabis day, since that is 420. But in all seriousness, it happened, and within 2 months, BP stock, which is this is what the chart is, fell 54.6% in less than 2 months. And there's a lot of lessons that one can learn from this. Besides, if you're going to panic, be the first to panic. For instance, buying opportunities. It took 4 years for it to get back to the pre-oil spill price levels. You can see on the left side of this chart, that's the precipitous cascade of the stock falling in a 2-month time span. And then you can see the higher highs and the retracements and the rallies and all of that fun stuff. I think this chart shows, was it an ascending triangle breakdown or breakup or breakout with higher lows in it. If I just noticed that. But so 4 years, but had you bought in the panic, you would have bought at $14, and in no time at all you would have been up a good amount. Now that presupposes that you would actually time it perfectly at $14, but you could say it was dead money. I don't know if they cut their dividend. I wouldn't be surprised if they did or got rid of it altogether. But one of the things you want to be cognizant of is that in moments like this, when a specific thing happens to a specific company within an industry, what often occurs is a sympathetic, sentimental move of a broad scale sell-off in other names within that sector, subsector, or industry. And that makes better opportunities, because you could say, I don't know what the legal liabilities of this is going of what this is going to imply for BP, and as a consequence, I don't feel comfortable investing in this company. But that doesn't mean that other companies didn't afford you a buying opportunity. This chart shows you ExxonMobil. ExxonMobil didn't dump a bunch of oil anywhere, but that didn't stop their stock from falling 41%. And it took Exxon 7 months to get back to pre-oil spill levels. So BP dumped by 50+%, taking 4 years to get back to that level, while Exxon sold off 41%, only, I don't want to say only, but only taking, a little inverse head and shoulders on this chart pattern, taking 7 months to get back to the levels. Then Shell, I'm not completely sure why, fell only, if you wish to say only, 18.5%, and it took it 5 months to get back. Now, another interesting thing is that I think a lot of people struggle with investing in this sector, or investing in the markets collectively, is that nothing happens for an extended period of time. And by nothing, I mean 10 or 20% volatility fluctuations in the price, and then things finally break out, if you will. So in this case, say you had bought Shell. Okay, so you own Shell for 8 months. And then in 2 months, you lost all the gains you made in the prior 8 months because it sold off, which means at that point you have dead money for 10 months. That's almost a year. That's to say you bought Shell, you were doing well in it for 8 months, then some other company does something bad, and then your stock gets punished and penalized fairly hard for 2 months, which means you had dead money for 10 months, and then it makes and regains all of that in 3 months. That's over a year. So it was doing well for 8 months, then it lost it all for 2 months, and then after that, you were then making money once again. So that's a year, and we've discussed this in prior videos about, well, the majority of my holdings, about how they ran hard in January and then practically did nothing except bounce around in a 10 or 20% range for 5 months, and then some of them have broken out fairly well. So it was just dead money for the first half of the year, and since I didn't buy into much of it until beyond January, I essentially was in dead money for months on end before I saw any results. And that's often the case. That's especially the case in the uranium sectors, as we've discussed in prior videos, about how it has a big move, does some 9-month or more consolidation, then has a 1-month big move, and then has a 9 or 18-month consolidation, and then a big move, and just on and on. And if you don't recognize that's the game being played, and that's not just a steady up and to the right chart, then you can be really frustrated. So by being more perspicacious and cognizant and aware of how that market in particular acts and behaves, then it can better position you to be quiescent and sitting on your hands, if you will, and just to recognize that's how the game's played. So Deepwater Horizon was an ultra-deepwater, dynamically positioned, semi-submersible offshore drilling rig owned by Transocean and operated by BP. So you might ask, how did Transocean behave? A stock I own. How did they behave when the BP oil spill occurred? Which is kind of interesting. Everybody knows it as the BP oil spill, but not the Transocean oil spill, which, is interesting. Well, it went from $74 down to $34. So it fell right in line with what BP fell. It fell, call it 53, 54%. The interesting thing is, well, it's not interesting. A thing to note is that it fell that much in roughly 3 weeks. BP took 2 months to sell off. Exxon took 2 months to sell off. Transocean took 3 weeks to sell off, which also means that it started rebounding before BP was even done falling. And that's a consequence of a smaller market cap company. Even back then, relative to BP, Transocean is a much smaller company. To Shell, to Exxon, to many companies. So they move quicker. That's why people buy these companies in part, because they have bigger moves to the upside that are quicker, but they also have bigger moves to the downside that are quicker. And this is a beautiful demonstration of that. Tidewater. Now, if you notice on the y-axis of the price chart, you see these crazy numbers, $16 or $1,517. Recognize that this is a split adjusted, price adjusted chart. And I think it was 2017. I think Tidewater had a 31 to 1,000 reverse split. So if you owned 1,000 shares, you now owned 31 shares. And was that a 30 to 1 split? But so keep that in mind when looking at this chart. And Tidewater fell. Now, an interesting thing about a couple of these companies, by the way, is that I think Shell demonstrated this and Tidewater demonstrated this. You'll actually see 4/20/2010, the price, and the stock actually went up. I'm not sure what happened. I'm not sure what the narrative driving things day to day was, but Tidewater actually subsequently went up in price on within the following week or two, which is quite interesting. Oh, one more thing. Oh, I actually want to go back. I skipped over this. I apologize. If you see, BP fell. And this is the problem with catching a falling knife. And that is that there's little rallies along the way. And you don't know which one is going to be the one. You could say, well, when the narrative changes, when debts have been settled or obligations of something, regulation comes down, some kind of a news-driven legal legislation. I mean, it depends on the catalyst, but you had a 8.4% rally on the way down, then you had a 7.5% rally on the way down, and then you had a 16.34% rally on the way down, and then it finally capitulated. There was something else that I wanted to say, but I honestly do not remember what it is, which does not make for good video. Oh, I wanted to say, no, I think it's coming up. So, nuclear. That would explain why I didn't see it, because I haven't seen it yet. Now, on to the Fukushima nuclear disaster. First thing I'd like to know is that we're actually finally closing in on uranium price from way back in March of 2011, which is when the Fukushima incident occurred, and uranium was at $59, the spot price. And we've actually touched upon it, and we're pretty close. Currently, I can't remember, spot's 57 or 55. So we're actually pretty close there. That's kind of interesting. But uranium was at $59 in March of 2011 when the Fukushima incident occurred. It did not bottom. Now, this is the commodity price. And since commodity players in the industry are really just a leveraged bet on the underlying physical commodity, then you should expect outsized moves to both the upside and the downside, depending upon what the underlying commodity does. Uranium did not bottom until November 16th, or November of 2016, falling 70%, taking 5.5 years. Okay, people right now might be looking at tin prices and how they're shooting up and down, or lithium prices, or coal prices, whether that be metallurgical or thermal, and these fluctuations, lumber prices, that's an amazing chart to see in the past couple of years. And to most people, and fair enough, a couple of months seems like a long time. A few quarters seems like a long time. But realize these things take years to play out sometimes. Perhaps even decades. And this, for instance, was a 70% decline that took 5.5 years. So this is what I wanted to, I was looking for earlier during the bad presentation on my behalf. Fukushima happened on a Friday. By the close on Monday, so it was March 11th, 2011. It was a Friday that Fukushima happened. So obviously the markets were closed Saturday and Sunday. That'd be the 12th and 13th. So by the close on Monday, March 14th, Cameco, which is this chart, Cameco was down 12.7%. Okay, so that's to say, in one day, it fell 12%. Now, this doesn't, these are open and closes, so that doesn't speak to the intraday levels, which, if you were paying attention to any of the bank stocks during the whole banking fiasco, intraday volatility during panics can be absolutely crazy. I mean, we're talking 100% moves off of intraday lows by the close. So I don't know what the intraday moves on this were. The point is, by the end of Monday, it was down 12%. By Friday, it was down 21%. So within a week after Fukushima, Cameco, the stalwart, if you will, the bellwether of the uranium industry, was down 21%. Now, the thing is, look at all of these rallies. This is a chart from when it happens. You see the dot on the left side of the screen all the way up to close to present day. And you have all these rallies. Look at this chart, because you might ask yourself, when is it over? When is it done? Let's go back here. Okay. If you notice, on Friday's close, it was actually off of the lows at 24.48. And then it's continued to rally. So then you can say, okay, the price has really been punished. I saw and observed the Deepwater incident last year, because that's really the thing. It's 2010, the Deepwater Horizon incident occurred, so maybe that's still fresh in your mind. And then so this uranium incident occurs, and you say, okay, I've learned some lessons. I'm going to wait and be patient, buy the dip, average down, something along those lines. You can say, okay, one nuclear plant in a country thousands of miles away from me is going to afford me good buying opportunities of industry participants. So you wait and you buy that 22% dip. Friday close, you put in a end of market order, let's call it, and you say, okay, I've initiated a position. I'm doing well for myself. But then you see that it, quote unquote, bottomed out at the end of 2011, okay? And it did that at $15. So you would have put your market order in at $24. Then it bottoms out at the end of the year at $15. So we'll call it 25 to 15 is roughly a 40% loss. So you're down 40%. It's the end of 2011. You're still holding on to this position, and you're like, oh man, okay. Maybe you're buying along the way. Then it rallies spectacularly in the first half of 2012, all the way back up almost to your $24 level. And then it gives it all back, and then goes back to where it started the year off. And then it does it again by the end of 2013. And can you imagine? This thing did not bottom until October of 2016, which is a month before uranium spot price bottomed. And then it subsequently rallied 79%. And then that's as far as it made it. 79% gets you back to, I don't know, roughly $12.50. And then it never goes past that for 4 years. And then COVID happens. And then it makes all-time lows. And almost touches $5. Now, I assure you, anybody who got in, well, more likely than not, anyone who bought in on that Friday close dip at $24 in 2011 is long gone by the time Cameco finally makes its quote-unquote final, because, the future hasn't been written yet, makes its final low of of, we'll just call it $5. And now you'd be up hundreds of percent from there. So maybe you exited that trade, took your loss, moved on, started looking at the uranium sector 2018, 2019, somewhere in that time frame. And then you got hit again, COVID happened, and then, so twice bit, once bitten, twice shy. So you're twice bitten, 4 times shy. And the problem is Kevin Muir on the Market Huddle, also writes The Macro Tourist. One of those you can get for free, one of them we have to pay for. He quotes someone that says, "Those who know it the best like it the least because they've been hurt the worst." And that's really something to think about, because sometimes you have to, like those who respect Paul Tudor Jones, he was well aware that sometimes you get into a trade, it goes against you, you get out, you take your loss, your small loss, and when things set up again, you try it again. And maybe you have to take a stab at it 3, 5 times. But at some point, when it finally goes, it's going to have such asymmetrical risk reward that it's worth getting those small stopped out. But most people can't manage that. So they don't, and they miss out on the opportunities. So that's another lesson to learn from this. Okay, you got it wrong. The uranium market was oversupplied, and this led to a whole chain of events that was hard to predict in both magnitude and direction and duration, and you get stopped out of your trade. But at some point you have to recognize and be objective enough and set your emotions aside and say, okay, I think things are really setting up. Like 2023 to me seems like a good time for uranium. And that's, along with Rick Rule, it seems like the zeitgeist has changed when Japan starts adopting. And I've made prior videos about all the countries adopting nuclear and reversing their talks about shutting their plants down and now extending the life of their plants, if not building even more plants, and other countries adopting it for the first time. And in Japan, they're the ones who started it all, and now they're the ones who's starting it again. That's a very unsophisticated, low-resolution, narrative-driven explanation of things, but it all started with Japan, and it all ended with Japan, and then now it all seems to be starting with Japan. It just, I don't know, seems fair enough. And then resource security with the whole Russian-Ukraine war, and in a combination of events that makes uranium seems like a good bet. But if you've been hurt by it a couple of times in the past, you might be more hesitant to get involved. And if you do get involved, you'll probably position size according to your emotions to try to assuage your emotions. So even if uranium really does outperform well, it's not going to be impactful to your portfolio because you're not going to have a sizable position on. And with that said, I thought I had another slide, so excuse the poor transition here. But these are the lessons that we can learn, or some of the lessons, there's many lessons still to be learned from it, of disasters. And if you're going to participate in the commodity space, like when Vale had the dam break in Brazil, the iron ore miner, they had that dam break and all kinds of liabilities and costs came with that. You have to ask yourself, okay, this is a good company, it's going on sale, but now it has future costs that's going to have to pay. When is a good time? You just kind of eyeball it and look at it and just keep up with it. Doesn't mean you have to get involved in it, but the commodity sector is a nice place to see that. Like you see in the tech space how European is going to crack down on Facebook, now Meta, or Google, or this or that, and then the stocks generally sell off a little bit, and then they rebound. Well, in the commodity space, it's an order of magnitude more dramatic than that. and they don't rebound as quickly, in part because there's less participants in the market than there are. I mean, just look how many analysts cover Facebook as opposed to how many analysts cover Cameco. So I'll stop it there. I do, unless something else comes to mind, next week I want to talk about position sizing and why you have to keep things in mind, like these one-offs, if you wish to call them that can occur, and how you use your position sizing. And I'll talk about my position sizing, what I do. I mean, 33% for a theme, 20% for a position. And that's because if offshore, let's say another Fukushima happens, say 33% theme. So I am 33% invested in uranium, let's say. And then a Fukushima happens. Well, guess what? I'm going to try to be the first to panic, which means that I'm immediately going to wipe out, let's just say 10, well, you saw Cameco close 12%. So if I'm participating with some junior companies as well as some majors, you could think in aggregate, my collection, to express that theme of uranium, in aggregate will probably be down, let's say 15 or 20% in one day. Okay? Can you imagine Fukushima happening on a Friday, and then all weekend you're just stressed, trying to educate yourself as much as possible, the implications, historical precedents, things like that, only for it just to open up, just for it to gap down first thing Monday morning. And everybody's rushing for the door. And sometimes the best thing to do is sell. Let the dust settle. I mean, sometimes that's the best time to buy, and you have to play it by ear. And then that's why having historical precedents can better inform you as to, do you add on this or do you sell on this? Has your thesis changed dramatically enough that you no longer feel comfortable in the trade? And that's to say that if 33% of my portfolio is down 20% in a day, like that's going to hit the P&L pretty hard. And that's why you buffer against these things with position sizing, as well as the names in those positions. So that's next week, hopefully, unless it changes. Yeah, there's some other things I'd like to touch upon, like the implications it has for my cash position. But if I'm in 25% cash and I have 33% exposure to a theme, in reality, my active portion of my portfolio is larger than 33% of my portfolio. Because if 25% cash, that means a 33% position actually is really affecting 42% of my active investing position. But we'll get more into that next week, so enough of that. So here I am. I think another week my portfolio is up. Things are getting too good. I get nervous when stocks go up too much. I get nervous when they stay. Well, I don't want to say nervous, but good placeholder, emotional words. I don't like it when they go down. I don't like it when they stay the same, and I don't like it when they go up, because I always fear something else. But I don't mind too much if they go down at this point. Buying opportunities, and I'm in 30% cash, and I kind of have a buffer. I'm up enough on some of my names that, I mean, they could easily lose all of their gains, but I've been up every week this month, and we still have Monday. That's the last day of the month. So this month, barring catastrophe happening Monday, I will have done pretty good for myself by my standards. And uranium is still just disappointing. Even though I just said 2023 was the year because of Japan opening up, even though that was 2022. So not doing the best, which is unfortunate. It's my largest single position and is the second largest theme in my book. So it'd be nice if it did better, but here we are anyway. And the one thing I want to touch upon before we end this video is my bank stocks. KRE and IAT. I'm up 32% and 25, almost 26%. And I'm really thinking about selling them. I don't. They're not high conviction trades. They were if you wish to say, a contrarian play on the banking fiasco of March, which is to say April, May, June, July, 4 months. I'm up, we'll just call it 30% in aggregate on those two names. So 30% in 4 months is 90% annualized, which is pretty good returns, and then collect a dividend along the way, and so that bumps it up a couple of percent. And they're not really high conviction name. I mean, I don't care about the banks. It's like a high single digit, low double digit return on equity kind of business. It's like, I mean, a 4% dividend. I think I locked in a IAT. I locked in a 4.69% dividend, and KRE I locked in a 4% dividend. So, I mean, that's nice enough, but, you know, if a sell-off happens, the question becomes, what am I going to do with this? This is my thought. So let me explain my thought a little bit. I have two thoughts on this. Right now, I'm in 30% cash. Soon enough, and I'm actually surprised this week wasn't that point. I really, like, genuinely was surprised. But normally, once I get to about 25% cash, I can no longer outcompete the S&P because my names just don't have enough oomph to them to compensate for 25% of my portfolio not participating. So that's to say that as a consequence, I could start underperforming the market in the short term. Now, this is about long-term absolute returns, so that shouldn't bother me, but it does because I'm a human and fallible and insufficient in ways, so that short-term underperformance does bother me. So by keeping the bank stocks, knowing how still sold off they are, short squeezes, people repositioning, blah, 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 they could still have upside. Now, they look oversold, or I'm sorry, overbought on the short term. The whole market, well, much of the market does, hitting the weekly Bollinger Bands to the top and so on and so forth. And they've had an impressive couple of weeks and all these things. And so so KRE and IAT are, let's see, market value of $48 and $39. So that's $87. So I would say that's roughly 10% of my active portfolio, which is to say if I sell them, I lose 10% of my active portfolio that will then be transferred to cash. It'll put me at like 36% cash. And so if the market does keep going up and these names keep going up, presuming they're correlated, that I'll definitely start underperforming the market, because going from 30% cash to 36% cash plus the typical cash flow, $42 a week, cup of coffee capital, $6 a day. That's how you get $42 a week. Like, I'll definitely underperform the market in the short term. So I'm a little hesitant to sell there, which means I probably... So that's the reason not to sell. Notice that said nothing about net interest margins expanding, and there's no fundamental story. It's merely I want to hold on to these names because I think if I don't hold on to them and I transfer it to cash because I'm not going to buy anything at this moment, then that means I'll underperform the market. So that means that they're kind of a low conviction trade, and they've done their part. They've made me money. I appreciate that. Thank you. But they're low conviction trades. So then the other side of that is if the market falls, well, these names are going to get hurt, and then that's going to contribute to my book losing money. But a bigger concern is what will I do with them? Say KRE goes from being up 32% to at one point being up 5%. Am I just going to sell it before I lose money on the trade and then I've round tripped the whole trade, but I don't have conviction and it's time for me to deploy capital? Because if it falls 30%, then I'm probably going to be in capital deploying mode. And at that point, I'm going to say to myself, I rather own other things that I have actual conviction in rather than this amalgamation of bank companies, which I'm not also quite sure as to how well they're going to do in the near to mid-term due to regulation and the economy or whatever else. And which isn't to say that I'm forecasting a recession. It's just like a what if. So it's like, and if we don't have a recession, then the names I'm interested in will do better than the bank names, more likely than not. And I just bought them because it seemed like a good contrarian thing to do. And so am I just going to sell it when it's up 5%, round trip the position, deploy the capital elsewhere, and leave money on the table that I could have materialized? And saying this out loud and verbally processing it, and I've thought about this a lot, more than I probably should. I probably wasted time that I could have spent elsewhere. I should have just sold the things and saved the mental investment and time and energy. But I'm strongly considering selling them. And a third of the moves done, you could say. If KRE fell 50%, then that means it has to go up 100% to break even. And KRE is now at 32%. So that's to say that it's about a third of the way there. And then, yeah, I'm leaving money on the table, but that money, there's an opportunity cost. What could I transfer? And that's another reason why I haven't sold them. It's kind of messed up because at the moment, I don't have anything to put the money into. You know, that's always a consideration. It's like, what's the opportunity set? Is there, because the opportunity set right now is cash. Which means the opportunity set, once the opportunity set manifests itself, in which I would have better use for the capital, I will have round-tripped KRE. It's very interesting. So then, do you sell it? And these, I mean, I've kind of made up my mind. Don't be surprised if it's not in my portfolio next week or in subsequent weeks. And this is the thought process behind it all. It's like, well, it's a low conviction idea, and I'd rather deploy the capital elsewhere. And as a trade, it's done well enough. I've held it for 4 months, and it's played out better than I perhaps expected. And so why not? You know, why? I told you why not. That's just it. When people say why not, it's more of a rhetorical question, signal ignorance or something. Like, there are reasons why not. And there's also reasons too. And you need to consult your conscience and take into consideration the variables, keep constant your comparisons, and evaluate the opportunity sets and the counterfactual opportunity sets, and then make a decision. And that's what I'm going to do, but I thought I would take you through my thought processes on the matter, and that's that. So, with that said, we'll end it here. Thank you for watching, and until next time.